founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the continuation in a LawCast series talking about reverse merger transactions. Determining the valuation of the operating business is necessary where negotiating an equity deal or concurrent financing transaction as part of a reverse merger. For business entities with operating history, revenue, and profit margins, valuation is determined by mathematical calculations and established matrices. Usually it's a 1x to 8x of EBITDA. For a development stage or startup venture, the necessary elements to complete a mathematical analysis simply do not exist. In that case, valuation is based on negotiation, future potential, and a best guess. Establishing valuation for a development stage or startup entity ultimately comes down to an investor's perception of risk versus reward. Risk is easy to determine. If I could get $300,000 cash for the public vehicle today, I may lose that $300,000 by accepting equity instead. Reward, on the other hand, is an elusive prospect based on the potential success of a business. In determining value, thorough due diligence should be completed and consideration given to numerous factors, including, for example, investment comps. Have investors, either private or public, recently funded similar companies? And if so, on what terms and conditions and at what valuation? Market data. What is the product market? What is the size of the market? How many new players enter the market on a yearly basis, and what is their success rate? Competition. Who are the major competitors? What is their valuation? How does this company differ from those competitors? Uniqueness of product or technology. How is the product or technology unique? Can it be easily duplicated? Are there patents, trademarks, and other intellectual property protections? Pricing and distribution strategies. What are the major impediments to a successful entry into the marketplace and the plan to overcome those impediments? Capital investments to date and details about what capital, such as outstanding preferred stock, warrants, and convertibles, are currently on the books. Assets and liabilities. Technology risks, including what technologies are being relied upon and how the company is implementing R&D to stay on top of it. Product development plans. Are there a model, or are there models or samples? Have they been tested? Have manufacturing channels been established? And what is the overall plan to bring the product to market and subsequently become a competitor in the industry? Legal documentation. Not only whether corporate records are in order, but are all contracts and arrangements properly documented? Future financing needs. Exit strategies. How will the current shareholders be able to sell? Will the shares have piggyback or demand registration rights? Will they be relying on Rule 144? Are there lockup or other additional holding periods? Management. This is perhaps the most important consideration. Does the management team have a proven history of success? Prior business experience in this and other industries? What is their work ethic, their general management skills, organizational skills, presentation skills, research skills, coachability, the ability to attract others with strong credentials who believe in the business and are willing to work to make the business a success? Does management present well in meetings and face-to-face discussions? These are all considerations. And finally, developmental milestones. Has the company achieved its developmental milestones to date? I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.